Welcome, everyone, to our panel this morning. I am Xavier Faz. I lead CGAP's work on digital business models. For those of you who may not be familiar with CGAP, CGAP is a think tank based in the World Bank focused on financial inclusion. First of all, I would like to thank Irene Arias and Sergio Navajas for their kind invitation to join this panel. Our discussion today will focus on digitalization of financial services and its impact on inclusion. Everyone is talking about digitalization these days. Typically, digitalization is something that is talked about as being about firms, how they digitize their processes, how they do investments, how they go about it. In our conversations today, we'll go one step beyond that, and we'll focus our attention on how markets are changing as a result of digitization. We'll begin by sharing a few observations on how digitalization is changing. So in our conversation this morning, we'll go one step beyond digitalization of firms. We'll focus on markets, how markets are changing as a result of digitalization. We'll begin by sharing with you a few observations on how digitalization is changing the business of finance and how this is changing the landscape in very fundamental ways. Ultimately, for us, it is what would this all mean for the poor and the prospects of more and better financial inclusion. So I will start with a brief presentation, and then I will introduce our panelists with whom we'll start. So many of you would have seen pictures like these recently. They are very commonly used to tell the story of how fintechs are becoming relevant in mainstream finance. You could pick the name of Bank of America at the bottom part for any major bank, including many in emerging markets. And this picture would remain true, or similarly true. The unbundling of products is happening at par with digitalization. Digitalization is not only about how firms digitize their own processes and products, but also how they adopt technology that allows them to seamlessly integrate third parties, like in this picture, the way the bank is integrating different products from different fintechs in their offering. And this makes a lot of business sense, both for the bank or the financial institution and for fintechs. Fintechs often have narrow innovations with very thin margins that don't allow them to make investments in building their own channels and a customer base. So it makes sense for them to piggyback on the customer base of an established institution. For the bank, incorporating fintechs helps them diversify their offering and deepen their relationship with their customers without having to make significant investments and without having to develop significant strengths into innovation, which is always a challenge for large established financial institutions. The technology that enables this seamless integrations between established financial institutions and third-party innovators also enables financial institutions to externalize their products, meaning that a financial institution may be one of the nodes in this graph in some other context, providing a particular product or service that someone else could distribute. A second observation is that this unbundling of the bank is pushing retail financial institutions towards a different kind of business model with significant pressures because it requires skills that are not typical of incumbents. For instance, it means a shift away from vertical integration towards models that are more distributed among players through outsourcing and partnerships. It also means that as consumers become more digital, they demand a broader variety of services, putting pressure on incumbents to quickly diversify their offering. This will be a new requirement to remain competitive. The unbundling of the bank also means that banks may be producers of products, especially those that require a banking license. Using technology to externalize their product offering, such as banking as a service, this enables third parties who don't often have a banking license themselves to rebundle and embed financial services in their own non-bank offering. And lastly, owning the customer relationship provides significant market power in this new context. Being at the front end allows you to track customers' preferences and behaviors and allows you to respond by stitching together others' services. So if I had to sum it up at this point, digitalization is much more than the technology transformation of firms. It is about being able to play effectively in this new space. Now, as firms digitalize and new players come into the space, players reorganize in markets along four key roles based on their skills, their assets, and their competitive advantage. What are these roles? Well, first is the balance sheet and risk management. This involves provision of capital and risk management at the wholesale or retail level, which is something banks and established licensed financial institutions typically do for themselves. But this means that it is being a role that is being externalized and could be offered in the market as a standalone business. Second is the role of product, offering a particular product or service that addresses very specific needs of particular segments of customers. Third is the customer relationship role, and this involves customer acquisition and all processes related to the front end, managing customer relationships. And lastly, distribution, which involves managing the physical access points through which customers interact with their providers in the physical world. Uh, this is mostly about cash in and cash out in most current markets, but that role might change in the future. This we call a modularized market structure when players take on these different roles. So how does a modular market structure look like? So this slide shows the landscape in Colombia. It's not a comprehensive slide. It is, but if you are a fintech or a platform that wants to play in Colombia, or any kind of player looking to play in the retail financial services space, this is the landscape where you'll need to find your niche. At the top, you can see the name of the digital financial services in the market. These are the plays that currently have more than 1 million customers. Each column shows the partnership arrangements and the role that different providers play. You can see that some of the leading banks like Bancolombia and Davivienda are still playing a significant role in the market with Nequi and DaviPlata, respectively. So three things to look at in this chart. One is the customer relationship layer. If you focus horizontally in that second layer going from the bottom and upwards, the customer relationship layer, you can see how new players outside of the banking space like Rappi and Movi are coming in with services owning primarily the customer relationship. At the product layer, which is the next layer up, horizontally, you can see how both Movi and Nequi are stitching together a diversified portfolio of services through partnerships with fintechs and other institutions. Movi has partnerships with Mo Technologies to offer loans and with Sura to offer insurance through their mobile wallets. Nequi, which is a bank-based wallet, offers MSC loans through partnerships with government guarantee fund called Impulsa. One could expect that RappiPay and DaviPlata on the right will eventually head in that same direction. The third thing to look at here is the modular structure. Once players digitize themselves and adopt technology that enables these seamless integrations, then it becomes easier for them to start playing different roles across these different stacks. For instance, Mo Technologies on the top left, which powers digital credit for Movi, could just as well be powering digital credit for any of the other players. It also means that if you're a fintech coming into this market, you could have a lot more space to play and a lot more ability to hook in and find your place in the existing ecosystem, because the modularity of the market allows you to more quickly integrate and find those partnerships. So lastly, These observations mean that the digitalization is changing markets in ways that probably will lead to increased innovation and diversification of products. But ultimately, the question remains, will this increase financial inclusion? Will costs be lower? Will there be more incentives to go down market for providers? Will these new products and services better fit the needs of poor people? And what about the new risks, the ways data is exchanged and stored across these different stacks? So let me leave it there as a way to introduce the topic of modularization of markets. I will now introduce our panelists. We have first Sopnendu Mohanty, who is Chief Fintech Officer at the Monetary Authority of Singapore. Welcome, Sopnendu. We also have Monica Ballesteros, who is Senior Manager, Policy and Insights at Economist Impact. Hello, Monica. We have Esteban Azul, Chief Operating Officer at Acción. Hello, Esteban, and welcome all to the panel this morning. So let me kick it off with a couple of questions to Sopnendu. Sopnendu, across the world, we see many fintechs claiming to pursue financial inclusion, but often this is not the case. Do you think that markets with a more modular market structure, such as what we have described here, create more opportunities for fintechs to drive inclusion?
Hi, thanks for having me at this forum. Extremely delighted to share my experience, especially the Asian experience in this space. Let me unpack that question in different layer. When you talk about a modular approach, it means many things at a many different layer. The first layer I normally react when it talk about modular approach is, are the fintech themselves modular? Are they solving a specific problem within the continuum of financial services? For example, you can be a fintech which is in the lending space, or you can be a fintech within the lending space doing credit assessment only. So this is the first layer of modularity. The second layer of modularity is the integration modularity, which means, are the recipient of the service have a design which allows you to plug in a modular structure so that you become part of a bigger system. So there's a modularity at the integration level. And the last, perhaps most impactful, is the regulatory practice activity based or modular in that nature. So let's unpack each of them. At the first layer, when you talk about modularity, definitely the market observation we have seen and the evidence we have seen in Asian market, that if you are a fintech and you are solving particular part of a financial services, in my example, I'm doing credit assessment using alternate data, I have a larger chance to able to work in multiple jurisdiction, because that particular value has little dependency on the foreign jurisdiction regulatory practices, because you're solving a process efficiency issue. So that's one. Let's look at the second piece. If you're talking about architecture where you allow different modules to integrate, that's where the responsibility of the financial sector comes, where the banks or the FIs in this context are designed to accept a modular integration. The role of APIs, the role of application program interface, because that architectural shift allows a modular structure to thrive. In Asian market, we have seen banks have pivoted last 5 years to an API architecture, whether you are insurance company or you are a classic deposit taking bank. Your architectural shift has now allowed an Asian market to able to accept this modular fintechs better. Hence, the geographical coverage this fintechs can make is now far more than the domestic market where they started that journey. On the third aspect, when the regulatory practices, this is an evolving practice. Many Asian markets have adopted a very activity-based regulation where they're trying to come with specific modular response to a regulatory refinement to innovation. I think that's through either through sandbox implementation or through a public consultation are able to refine the existing regulation and respond to a particular modular upgrade if they need to. So these are the three layers. And if you look at each of them, if you bring it together, it does increase the adaptability. It does increase fundamentally a real impact on the financial inclusion. Because if you think about a non-modular approach, it takes a lot of time and it may not succeed. But with the modular structure, the impact is faster, quicker, sustainable, and has a scale impact.
Thank you, Sopnendu. So let me just follow up on something you said. There seems to be a change in the calculation for fintechs when they think about their business model, whether they can work in one market and are subject to just making investments to launch and work in one market, or versus they do something that is applicable across markets. In this context where you have modular markets across a region, how does this change the calculation, the business calculation, or business model design for fintechs? Do you have a view on that?
Absolutely, Javier. This it all depends. And I always say there are two kinds of fintechs in the world. There is a B2C fintech and there are B2B fintech. The B2C fintechs are doing financial activity, so they are regulated. They compete against incumbent, and the regulatory practices they are obliged to can vary from country to country. Hence, there is a scalability challenge. So that's one bucket. But what I'm really talking about is the second bucket, which is the business to business fintech. And what we see in the Asian market is a significant growth in this space where a particular fintech is not necessarily competing against an incumbent on a regulated activity, but is providing high value digital services to make an existing FI in an existing market to be far more efficient and far more impactful. In that context, the business model does allow scalability, does allow multiple market operations a meaningful way, and does allow some kind of interoperability in different market. So that's the model difference.
Got it. Thank you. So you can also think that a B2C business could white label its service and turn it into a B2B business and then benefit from those other attributes you mentioned.
Yeah, very good point. In fact, let's look at evidence. And if you look at the Alipay, which was highly successful in China, when they went to different market, they did not bring their direct payment practices. They in fact gave the tech stack to many market. So and that tech stack became a white label infrastructure for many local players. So highly successful Alipay in China is highly successful as an infrastructure play in other market. So I think that's the beauty of a model shift from a domestic market as they move outside the domestic market.
Yeah, that's really important for regions that have many countries with smaller markets where you would like to see a lot more penetration of innovative services, but because they're smaller, it's hard for innovative startups to really make a business there. But let me ask you just one other quick question. What do you think should be the regulator's role in ensuring that more inclusive offerings exist in a market? Are there any lessons you can share from Singapore or from Southeast Asia?
So the Asian market did made a significant investment in a particular topic called public good, and I want to bring that to the discussion because that's important for any fintech to succeed, especially serving the inclusive market or inclusion market, and whether it's Singapore or India or Philippines, there are four foundational infrastructure which you see at different stages of development in the Asian market. What are the infrastructure? The first one, a trusted digital identity, whether it is a corporate or it is an individual, because that's almost like the foundation of a digital native solution, and it is a public good. The second infrastructure is around trusted data gateways, because ultimately these fintechs, when they build solution, the diet or the food they feed on is data. And the data they feed on has to be trusted, regulated, well managed, well governed, and also ensure there's enough protection for the people they're serving. So a trusted data gateway infrastructure. And examples in Singapore, there's a SG Findex. You can always Google and check out what it does. Third, an interoperable payment rails. Very key infrastructure, because a lot of fintechs today arbitrage inefficiency in market that they should not actually do. What fintechs should focus on high value services. It is the responsibility of the government to build an interoperable public rail where payments can move efficiently. Many significant investment has been made in Asian market to make payments easier, proxy address driven, cost is close to zero, and also connected outside different market, interoperable cross jurisdiction connectivity. Plenty of examples: Singapore, Thailand corridor, Singapore India corridor, Singapore Malaysia corridor are all getting connected. And the fourth aspect, which is perhaps the most philosophically, most culturally, the most powerful element, is the need for a consent infrastructure. Why do I say that? Because we are dealing with poor people who may not have understanding of the data abuse. So the power of consent must be given through a market infrastructure where everybody who shares the data consent to that data before a fintech provides the services. Having this four foundational infrastructure has been the bedrock of Asian story for last 5 years. And what is being built on top of that is all the fintech application, which will be trusted, far more scalable, and far more interoperable.
Thank you, Sopnendu. Let me switch over to Monica. Hello, Monica. We have barely 5 minutes, but I wanted to ask a couple of questions. One is, you work with the intelligence economic intelligence unit, and you work with the microscope report, which has been active since 2007. The changes that we're talking about here have been changes that have been happening in the last few years. They've been evolving in the last few years. So the question for you is, in your assessment of markets, how do you take into account, how do you deal with these changes that have been occurring in your assessment of readiness for financial inclusion?
Mm-hmm. Thanks, Javier. I'm very happy to be here as well. So just for those who don't know it, the Global Microscope is an index that assesses the enabling environment for financial inclusion. We usually look at the sort of low and mid-income countries, so not necessarily, countries that have the infrastructures and the regulatory maturity that other countries like Singapore might have. And for us, we started really this as an index of microfinance in Latin America in 2007. There was no data on how to regulate or how to what policies could enable this space. So that's where we started, and we have evolved with the field. So in 2014, it became an index on financial inclusion, and then in 2018, we started doing the assessment of digital financial services. And by the way, we have been able to do this with the support of IDB Lab, the Bill and Melinda Gates Foundation, and the Center of Financial Inclusion at Axion. So very happy to be here with all of you. And basically, I remember when we were doing the methodology review in 2018, we were very focused on the technologies, on the digital financial services aspect of it. And one of our experts warned us, the biggest challenge that regulators are going to face is not technology per se, but the number of stakeholders that are coming into the space and the diversity of stakeholders. So how do you sort of help coordinate them and then regulate them to protect the system and protect the consumer? So I think two of the things that we kept in mind, and I think characterize the countries that do best in our ranking, is this sort of government coordination. I love what Mr. Mohanty mentioned about the corridors, because it's not just intra-government coordination, but also with other countries. How do you sort of harmonize regulation? How do you share infrastructures? And then the second one is sort of this ability to continue thinking about regulation in a risk proportionate way. So think about a product, think about a new offering, and think what's the risk that this sort of represents for the financial system, or what is the risk that it represents for the consumer, and how should we regulate it proportionally so you don't inhibit innovation as well. So I think those are the two main principles that we've used from 2007 onwards in our microscope.
Got it. Thank you, Monica. So if you could sum it up, going forward and looking at how this modularized market structure is changing the landscape, what would you say would be the greatest challenges we should be still thinking about in terms of regulation?
Mm-hmm. Yeah, so actually we were very lucky this year. We're not collecting the data as we usually do for the microscope, but instead what we did is look back at our data from 2007 and try to answer a question that many people ask us. So what are the policies and regulations that are actually enabling financial inclusion? What is actually moving the needle for different countries? And what we found, the first, and I think Mr. Mohanty already mentioned it, is investment in infrastructures. It's paying off. And also interoperability is very important. And when we think about infrastructure, I mean, for a lot of low income and mid-income countries, we start with connectivity, right? We can't talk about a digital financial services or a digital transformation without connectivity for the end user. Digital IDs, payments infrastructures, and this interoperability of services is key. The second one that I think sometimes is not as talked about, but for the microscope has been really central to our assessment, is consumer protection, right? The risks, especially as we move into a digital space, are becoming bigger and more complex. So it's important that we always keep in mind the consumer, and that in the end, the financial system should serve the users, no one else. And then the third, I think, and this is one of the biggest worries of the regulators, is cybersecurity, right? And the new sort of risks coming in from all of this fast space and data and regulation. So I think cyber is still a challenge, and we'll learn a lot more as we go ahead. So those are the three things that we've kept in mind.
Thank you, Monica. These are really, really good points. Esteban, let me turn now to you. And looking back at the conversation we just had around changes in the market structure, this modularization of finance, and how do you see this landscape presenting opportunities, or this evolution of markets? What does it mean for microfinance? If you look to the future, do you think MFIs should pivot towards a role of broker and steward, helping underbanked segments access the fintech universe in a safe and effective way?
Thank you, Javier. It's great to be here with this great panelist. You're really asking about the role of microfinance institutions, and first of all, thanking IDB here for this forum. It's amazing how much the forum has changed in the last 5-7 years, right? So that's a reflection of the market. I would start by saying that, of course, not microfinance organizations are the same. Just like banks have changed significantly. I remember not too long ago, 5-6 years ago, the conversation was banks versus fintechs. Well, it's not really, and the same applies to MFI. So it's not one versus the other. It's how we can work together, how there could be partnerships, acquisitions, and so forth. So let me use a couple of examples to illustrate how we see the role of microfinance organizations, particularly in Latin America. First of all, and your question in a way implied that MFIs having an incredible client base, and that's a gold mine for MFIs in terms of changing products and services, adding partnerships, or providing new businesses that we didn't think of before. And secondly, I think we should not forget the pandemic. The pandemic has changed the life both of microfinance organizations and clients in Latin America. Less than 24 months ago, and Javier, you've taught classes in this, on the trust in digital versus cash. The numbers in each Latin American country are incredible, and they show how clients have adapted to trusting digital, perhaps forced by the situation of the pandemic. And we see incredible rates in Colombia. Right, we have to do more data analysis to be very robust, but 60-70% increase in Bolivia, as much as 280% increase in the use of digital products. But more specifically, let me tell you how I see the role very concretely. I think microfinance institutions have a future, particularly the large and mature ones, but not all microfinance institutions will survive. If you're not digitally transforming, you're going to be out of the market. I think most of them are. But let me pick on 3 quick examples. First, Mi Banco in Colombia. I was just having lunch with the general manager of Mi Banco yesterday, and how he has changed his own metrics in the last 18 months of the pandemics to put client loyalty as the number 1 metric, because he can see that he will be in the next 12 months competing with an Awala or somebody else in the market, but he has the client base and the trust that other fintechs don't have. And that's one path forward. Another one is Mi Banco in Peru. What Mi Banco has done in terms of data management is amazing. It parallels any of the top banks in the world in terms of using the richness of data to analyze how they can work inside an MFI, what new products and services they can provide, and how they can partner with fintechs in new businesses that they never thought of before. And the last one, where I happen to be the board chair, I think very, very subjectively a jewel of microfinance, the Banco Sol in Bolivia. We basically are thinking of 3 banks in one. One, we're not going to forget the touch model where we have closeness with the clients, and that's an asset that we have, even using the technology, of course, in the future. Second is the digital transformation of the bank. And third, and this is where I see the role of MFIs, less as a broker, but the strong MFIs should think of how to consolidate, how to acquire MFIs, fintechs, how to partner with fintechs, and how to drive their own fintech strategy in the future, always thinking of how to serve the client better. The last word I would say about MFIs, because I know we have many of our friends here listening, the days of the single mono product are over. The days of an institution just providing loans, particularly in that traditional way, are over. And if it's not over yet, it's going to be over very soon. But I do think MFIs, working with fintechs, acquiring them or partnering with them, there's a lot we can do in the future to work safely and responsibly with clients.
Thank you, Esteban. That was a very comprehensive response, and I think it paints a very compelling picture of what microfinance is and could be in this new environment. Certainly, we all want to see more of these examples like the ones you mentioned. Esteban, one other question. Acción was a pioneer in the field of inclusive fintech with their forming of Acción Venture Lab. As markets modularize, do you see opportunities evolving for investors who want to drive inclusion through fintech? What is your view?
Thank you for that question, Javier, and I think it's a very apt one in today's world. First of all, very quickly, as you mentioned, Acción did the first global fintech for the underserved in financial inclusion 6 years ago. We put $10 million, frankly thinking we would lose it all. That the idea was to learn how the market would evolve, and to support seed stage companies in innovation. Fortunately, we've more than doubled that initial investment. That was not the objective. We've benefited from the rapid changes in the market. Now we have Venture Lab, what we call 2.0, where we're managing third-party funds. And we plan to do a lot more in the next 12, 18 months throughout the world, focusing regionally and, of course, not forgetting Latin America. A few things we see is more specialization in themes. A couple of my colleagues here in the panel mentioned it. We see a lot of development in embedded finance. We see a lot of future when we think of investors in the next 3 to 5 years in using platforms to add a variety of product services, again, multi-product platforms. We see a lot of developments, very attractive developments in Chile, in Brazil, in Mexico, in AgTech. I think AgTech is going to be very hot in the next couple of years. And Monica, you mentioned it, and Javier, you as well, in MSMEs. A couple of quick learnings. One is that for every 2 investments we make, we look at 100 companies. And after that, for every 10 investments we make, 2 or 3 fail, 4 or 5 do okay, and 1 or 2 do extremely well. So you're supporting innovations, you're going to take some risk, and you have to, in my view, support the managers that are experienced and know what they're doing in this sector. There's no doubt we are in a huge bubble in fintech. This is a bonanza, the pricing, the valuations. I come from a traditional banking sector. I cannot understand them. There's a lot of enthusiasm, but some of it, we have to admit, is driven by too much liquidity, a historic high of global liquidity in the market, and very few sectors that large investors are investing in. So I think we're going to see this bubble for another 12, 18 months. I think then it's going to crash. I think valuations will come back to normal. But what's not going to change is fintech is here to stay, right? Right now, we use, Javier, the words fintech, digital. I don't know what you think. In 5-7 years, the word digital will disappear. The word tech will disappear because it's all going to be tech and digital. But for investors, stay in the long run, be careful in the short run, support innovation in early stages, and support successful fund managers. It's not just Acción, there's many others in the space. And we're supporting innovation, entrepreneurs that are starting new businesses, and we can really make a difference and scale and reach those that need it most in the underserved way in financial inclusion, which is what we do.
Thank you, Esteban. I would definitely agree with your views. One last question, and hopefully a brief question, is there's a very strong message we're coming to the market with for MFI, saying you need to digitalize. The future is in adoption of technology and so on. What should be the message for fintechs around microfinance? Should fintech, around the opportunity in microfinance? What is the message that we, maybe they are overlooking what opportunity might be there? What would be your message for fintechs regarding microfinance?
Yeah, great question. Very quickly, we work with over 100 entrepreneurs throughout the world, and I know I've learned a lot on how busy. If we think we're all busy, they wish they had 35 hours in a day because they're very focused. When you're innovating, starting up, there's so many headaches, and they often don't look to the side. And I think you're raising a good point. I do think they can learn experiences, because what MFIs and others know the customer. So don't forget the knowledge of the customer. As I said, out of 100 fintechs, frankly, less than 5% really make it. So know your customer, learn experiences, and be willing to partner and innovate in those partnerships and willing to work together. We see a lot of those examples today with the Destacame in Chile is a great example of a fintech that's partnering with large banks and MFIs. Confio in Mexico is in my way, a nouveau digital MFI, but David in Mexico has learned from looking at what has gone well and not well. So lessons learned, know the client. I guess if there's one message, is know the client and learn from what the MFIs, because there's a lot of richness in what to do and what not to do.
Excellent. Thank you very much, Esteban. And also thank you very much for the rest of the panel. I think it was very useful contributions. Now I would like to introduce Eric Parrado, who is Chief Economist and General Manager of the Research Department of the Inter-American Development Bank. Eric, welcome, and I leave it to you for the final words on this panel.
Thank you, Javier, and thank you for all the panelists, Monica, Sopnendu, Esteban, and you did a really great job moderating this great panel. And this has been a fantastic discussion. It's really exciting to see how new technologies can push the envelope of financial inclusion and help millions of people across our region access financial services that were out of their reach for such a long time. In terms of the financial system, one thing that has stood out to me as we have tried to navigate the pandemic is how different roles of financial market has been compared to previous financial crises. This time around, financial markets were not part of the problem, they were part of the solution. And for example, a recent research project in partnership with MasterCard shows that SMEs in the region were able to soften the blow of the pandemic by taking their businesses online and scaling up web-based sales in the digital economy. Without access to digital payment options, this transition wouldn't have been possible. In addition, several countries partner with the private sector to deliver cash transfers to families in need. One example is the case of Colombia. Here, the government partnered with leading financial institutions to open roughly 3 million digital savings accounts so that the beneficiaries of their emergency cash transfer program could receive funds directly on their cell phones. And beyond the economic support provided to households during such a dramatic situation, There is no doubt that the legacy of this policy effort is financial inclusion. Millions of households gain access to digital financial accounts, digital payments, and the digital economy in general. What was once seen as a privilege available only to the wealthy is now a reality for many people. Fewer people need to stand in line to conduct basic transactions, and through digital payments, the menu of products available for our citizens has expanded a lot. And as more people have access to digital payment options and can engage in e-commerce, firms have seen their customer base expand. One way or another, including millions of households and micro, small, and medium-sized firms, has been at the center of the COVID-19 response of several countries in the region. Over the past 18 months, we witnessed governments cooperate with the private sector and financial institutions. One of the biggest success stories of the pandemic is how the public sector and private enterprises came together for a common cause. However, there are two central challenges for our region. First, in cases where this positive public-private partnership thrived, the new goal now is to transition from an emergency response to recovery. Millions of people and businesses now have access to digital payments, and we need to make sure that increased access translates into broader use of these financial instruments. We need to work on increasing financial literacy and on the development of user-friendly digital financial platforms so that the most vulnerable groups of society can take full advantage of all the new financial technologies. Second point, in countries where the public and private sectors were not able to act in concert in the same way, we need to sit down and work together to develop a financial system and regulations that make these partnerships possible in the future. That may entail meeting the infrastructure and connectivity needs of digital financial technology, but also building a financial system that is not only stable and profitable, but one that also has inclusion as its top priority. Building modern and more inclusive financial system is crucial for our region and central to the IDB's Vision 2025, which focuses on spurring SME growth, ensuring that everyone is part of the digital transformation, and contributing to a society that is ready to confront the threats of climate change. Inclusive financial markets are crucial to these goals. We therefore need to create spaces that, through the lenses of rigorous evidence and data, foster the debate on how to build back a better economic environment for our region, one with more inclusive financial markets that leave no one behind. As a response to this need, the IDB Group is working on setting up a knowledge hub for financial inclusion in Latin America and the Caribbean, known as FinLAC. FinLAC will promote greater knowledge sharing of up-to-date market data, effective policy experiments, successful investment transactions, effective technical assistance projects, innovative business models, and dynamic partnerships. The idea is to make financial inclusion a key part of economic transformation, treating it not as a part of a niche market, but rather as a natural extension and characteristic of a modern financial system. Our goal is to be a one-stop shop for issues related to financial inclusion in Latin America and the Caribbean. So I invite you all to come to join us in this initiative to build better financial system for our people. Thank you again for tuning in today. We are really excited to keep making financial inclusion a reality, hopefully with your support. Thank you very much.
Excellent, Eric. With this, we close the panel, and I take it, I give it back to the organizers. Thank you.